Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 2nd, 2025. I am Luna.
I am JPMorgan.
Okay, let's unpack this because it was definitely a mixed picture on Wall Street yesterday. We saw, a clear split. The Dow Jones climbed, 0.91%?
That's right. Pretty solid gain.
Yeah, boosted by healthcare, materials. Those seem strong. But then the S&P 500 was, basically flat. And the Nasdaq, the tech index, actually fell, down 0.82%. What's your immediate take on that kind of divergence? Is it just profit-taking in tech or something more?
Well, I think what's really insightful here is seeing that clear sector rotation happening, that Nasdaq dip. Yeah, largely profit-taking in those big tech names. I mean, they've had an incredible run, hitting record highs, so some cashing out makes sense. But the bigger story, I think, is the shift away from high-growth tech. Investors seem to be moving towards, value and maybe stability. We saw those defensive areas, the cyclicals, think financials, industrials, they gained ground.
Right.
While tech and communication services, they definitely lagged. And that often signals a bit more caution about future growth prospects.
That makes sense. And beyond the big indexes, there were some really specific company stories that I think highlight what's driving things. Tesla, for example, it dropped over 5%. The report mentioned this kind of public disagreement between Elon Musk and President Trump.
Yes, over that new tax and spending bill.
Right. And that seemed to inject what the report called political risk. Big impact on Tesla sentiment. Maybe tech investors generally.
Absolutely. A clear example of non-economic factors hitting a stock.
But then on the flip side, you had the traditional car makers surge. GM was up, 5.7%, Ford up 4.6%.
Huge jumps.
Yeah. And that was off strong Q2 sales numbers. Seems like people were rushing to buy cars before potential new tariffs kicked in.
That's the narrative, yeah. Pre-tariff buying, giving them a boost. Those individual stories, Tesla's drop, the auto surge, they really aren't isolated. They're symptoms of these larger economic forces. And speaking of larger forces, the Fed's policy outlook is always, front and center.
Always.
And we're seeing a bit of a split view there, too. Treasury Secretary Scott Bessent suggested rate cuts could happen certainly by September. He even seemed a bit puzzled tariffs haven't forced a cut already.
Okay, so he's expecting cuts soon.
But then you have Fed Chair Powell. Speaking at that ECB forum, he was more cautious, basically reiterating the Fed wants to wait and learn more, especially about how tariffs might affect inflation before they ease up policy.
So Powell's pumping the brakes a little.
Exactly. So the bottom line for you listening is, yes, expectations for a September cut are higher now, but it's clearly going to depend on the incoming data.
Okay, so while the Fed waits for data, what is the current data telling us? Let's shift gears to manufacturing. June's ISM PMI reading came in at 49.0.
Right, still below 50.
Yeah, below that key level, separating expansion from contraction. It's up a bit from May, but still the fourth month in a row showing contraction.
And the commentary from factories in that survey was pretty stark.
It really was. They called conditions extremely challenging, hellacious even, too volatile for long-term plans, and they directly pointed fingers at, quote, the tariff situation, messing up sales both globally and here at home.
Those quotes really bring it home, don't they? It's not just abstract numbers.
Exactly.
And it leads to an interesting question because manufacturing employment actually fell in June.
Right.
Yet the May JOLTS data that tracks job openings it showed this surprising surge. Openings jumped by 374,000 to 7.77 million.
Wow. Highest since last November.
Highest since November, driven mostly by leisure and hospitality, interestingly enough.
So fewer manufacturing jobs, but tons of openings elsewhere. What does that mean?
Well, it's a mixed signal, right? It hints maybe that the labor market is in flux. Businesses are still advertising for workers. That shows demand is there. But the drop in manufacturing hiring, coupled with high openings in other sectors, it suggests maybe a growing caution about actually filling those roles. Could be a sign the labor market is softening a bit, even if the headline openings look strong.
So putting this all together, what should we be watching for next? Thursday, July 3rd, sounds like a big day for data.
A very big day.
We get the June employment report from the Labor Department. The forecast, I think, is for about 110,000 new non-farm payrolls, and unemployment ticking up just slightly to maybe 4.3%.
That's the consensus, yes. Those figures, plus the ISM Services PMI, which also drops on Thursday, they could definitely move the markets.
What are the main risks you see on the horizon then?
Well, obviously, that July 9th tariff deadline is looming large. There's the risk of inflation picking up if tariffs do hit consumer prices. And just the ongoing political developments adding volatility. So for you, the listener, I think the message here is really caution and diversification. That seems paramount right now. The market is clearly trying to balance hope for Fed cuts with this real economic uncertainty. And it's pivoting fast on every new data point, every headline.
Mm-hmm. That's a really critical point, especially now. So keep a close eye on those jobs numbers Thursday and really listen to what the Fed is saying. It feels like a good time to just double check that your portfolio is, balanced enough to handle different potential outcomes. Because while all this short-term news causes swings, the bigger picture is still an economy that's growing, right? And a Fed that seems ready to step in if needed. So final thought for you is, how do you prepare for what looks like continued choppiness while still keeping that essential long-term perspective?
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.